The registered person has the primary relationship with the customer, and so they are in the best position to know the client. Meeting the suitability requirements falls on the registered person, who can't delegate this to an unregistered person. The suitability obligation is the obligation of a registered person to determine whether an investment is appropriate for a client. An assessment of suitability requires that the registered person understand the product and enough about the client to assess whether the product and client are a match. Suitability is triggered whenever a registered person intends to make a recommendation to a client about an investment action, security, investment, or trading strategy, fee structure, and method of financing involving a security. Suitability requires the registered person deal fairly, honestly, and in good faith with their clients, and the client-focused reforms explicitly say that a registered person must put its client's interests first when making a determination of suitability. You may wonder what it means to put the client's interests first. It doesn't mean the registered person is guaranteeing a financial outcome. It does mean that the registered person has enough information, that you are looking at the client's overall circumstances, including their entire investment portfolio. For example, you are considering whether a recommendation for one account might materially impact across other accounts, that your bonus or compensation isn't a factor in your recommendation. Instead, you're relying on your professional judgment. And the client-focused reforms explicitly say that a registered person must put its client's interests first when making a determination of suitability. What are some things you need to consider in the suitability analysis? Keep in mind that a registered person cannot determine suitability without first complying with KYC, KYP, and due diligence obligations. Based on information reasonably available to you at the time, consider the client's KYC information, financial objectives and risk profile, both negative and positive factors involved in the transactions, over-concentration in a type of security, market conditions, redemptions, other liquidity restrictions, too much in a sector or industry, single issuers, or the same group of issuers, single asset or group of assets, asset class, illiquid exempt market securities or liquid publicly traded. Also consider the costs of those products. Costs can significantly impact a client's return over time. The client's returns should be assessed considering the compensation paid to the firm or registered person, even if the costs are paid directly or indirectly. This would include all costs and fees for purchasing, selling, or holding a security. When will you do this suitability assessment? Remember that a registered person cannot determine suitability without first complying with KYC, KYP, and due diligence obligations, and specifically, the client-focused reforms say the registered person must do this suitability analysis before taking or recommending an investment. Keep in mind that appropriateness of an account differs from suitability. It is a one-time obligation conducted before an account is opened, but suitability tracks the appropriateness and is also carried out after the account is opened. The suitability obligation is also an ongoing requirement to conduct periodic reviews of a client's account and reassesses suitability and should be done with certain trigger events. These events are defined by the regulators when there's a deposit or transfer in, a change in the registered representative, portfolio manager, or associate portfolio manager. There is a change in the client's information, like their personal or financial circumstances. The registered person becomes aware of a change in a security. This also applies when you receive instructions from a client to transfer or liquidate securities. How do you know when a reassessment is needed? Suitability obligations should be performed mindfully, considering the client's interests, like tax consequences. The suitability determination should be done in a timely manner and based on the nature and circumstances of the event. For transfers in, for example, they should be done within a reasonable time after opening the account. Again, the registered person should use their professional judgment to determine whether the client relationship needs to be reassessed. Guidance provided by the regulators suggests a registered person look at each client circumstance individually and think about the type of event, the relationship between the client and the dealer or registered individual, the services and securities offered by the dealer, and the types of the securities in the account. Can the suitability determination be made for multiple accounts? Yes. Multiple accounts held by one client can be assessed together if the needs, objectives, time horizon, and risk profile are the same for all of the accounts. The same PM is responsible for all of the accounts. We can supervise the accounts, and the client understands that that's what the portfolio manager intends to do. So, you need to communicate this with the client. For multiple households, the registered person still needs to perform account-level suitability, but it can be done by household if everyone in the household, aside from minors, agree. When the regulators review our clients' files, they're looking at what a reasonable registered individual with a similar business model would have done under the same circumstances. So, while you're exercising your professional judgment, there are some things you should not do, like rely on outdated information, fail to document their suitability determination analysis, fail to consider both trade and account portfolio suitability, mold the suitability analysis to drive a certain recommendation, over-rely on asset allocation or risk assessment tools, or make a suitability determination that does not put the client's interests first. Sometimes there might not be an appropriate product, service, or account for a client or potential client. It means that the portfolio manager does not need to open the account. When considering appropriateness of accounts, or whether to even open the account, and while putting the client's interests first, portfolio managers must also comply with conflicts of interest rules. Similarly, if the client wants to do something you don't agree with, or against your advice, the portfolio manager should make note of their recommendations. In all cases, document, document, document. This is the most important action a portfolio manager can take to support their client and show they considered their client's interests first and above their own. You can document suitability obligations and use your professional judgment to determine reasonableness in the circumstances in a number of ways. Suitability, know your client, and know your product obligations are conceptually distinct, but in practice, they are closely connected and interwoven. Let's turn now to KYC.